If I'm investing now, let's say I have savings. Let's use the $100,000 as an example. Like, what fees, and if I'm not comfortable like doing it all myself and reading 300 books and all this, like what are the fees I need to look out for? What are the biggest, thieves?
Okay, the key fee that you need to understand is the management fee. Okay, this is a fee that is taken from your account every single year. So, for example, if you invest in a mutual fund, this fee can be 1 or 1.5% or 2% every year. Okay, so this is the management fee. The same goes if you have a financial advisor. He or she usually they charge 1% or in this vicinity per year. So this is the management fee, and this is
Right.
the biggest
And there, the
revenue.
financial advisor, let me ask there.
That's
So a financial advisor can advise you to invest into funds that also charge a fee. So now you're being charged double fees.
yeah. That's
Right.
that's
Okay.
correct. But let's take a look at a simple example, so that you understand, so that everybody understands how much these fees can really drain your accounts. Let's say that you have a portfolio of 100,000. Okay. And you don't add anything. You just stick with 100,000 to invest, now, and then you just leave it for 10, 20, 40 years, okay? For your pension or whatever. Now, 1% fee per year means approximately 1,000 per year, okay? So 1% management fee out of 100,000 is 1,000. Now, this 1,000 is taken out of your account and is not growing anymore. So over time, this 1,000 would grow quite a lot. So, for example, if you have 8% annual growth rate, for example, 8% average gains per year, now historically, the stock market produced approximately 10%. So I'm very conservative here, okay? So 8% per year. So if you had invested that 1,000 that went out of your accounting fees over 30 years, that would amount to 10,000 euros or US dollars. Okay. So over 30 years, 8% growth, 1,000 becomes 10,000. Okay. And this is just 1 year of fees. And you need to compound all these years, together. And over 30 years, what happens with your money? Basically, because of this small 1% fee, you lost more than 120,000 US dollars or euros, because of this small 1% fee. So this is the compounded amount of money that you lost because of this small fee. So it's more than your initial investment, okay? And this is the real cost of being in a product or being with a financial advisor for a prolonged period of time when you have these small fees. And this is, most people don't understand this, and it's hard to understand because we just see maybe 1 year fee. We see 1,000 and we can't comprehend that this in 20-year time or 30-year time, that this will grow a lot, So 1,000 over 30 years, if you just have 8% growth, is 10,000. And altogether, if you account for all these 30 years, you lose more than 120,000, because you hit 1%.
Well, let me devil's advocate here, though. So, let's say, because now, if I am the investor, I put away 100,000. If I'm making 8% a year, and I'm, so to speak, giving away only one, that means I still keep seven. So over that time, my 100,000 will still grow by a lot in theory. If it's going to grow that much, why is that 100,000 such a big deal? Because I know there's more to this.
Yeah, you just need to think about the alternative. What if you just invested in basically the same product, the same thing, but with 10 or 20 times lower fee? You would basically, when you retire, you would have 100,000, 200,000, maybe 500,000 if you invest more, more on your account. And this could mean the difference between a comfortable retirement and maybe a lot of financial problems, when you get to retire. So yeah, it sounds little, but over time it really grows by a huge margin, and it can basically create a lot of problems, for people.
Yeah. And of course, the big problem is they get paid whether the market is going up or down. So if the market goes down, they're still taking that
Yeah,
out, which
it's even
actually hurts your account
if the
even more.
market, if there is a financial crisis or recession or whatever, these management fees are even worse because the market goes down and then also they hit you with these fees. So you start to lose a lot more, and it's very hard to recover after that. In my home country, I come from a very small country of Slovenia, and a lot of people were investing in our home market and the neighboring countries and so on after we gained independence in 1990s. And because these markets, in the financial crisis of 2008, 2009, they went down like 80 to 90%. They still haven't recovered, because of all these fees and because the market went down so much. And they're still underwater. But if you have invested in a simple, low-cost global ETF, so these are the index funds, these are funds that have very, very, very small commissions and fees, you would recover your investment already in 2013 or 14, and now you would have like 200 or 300% profit. So this is, this is a big difference, having a 200% profit or maybe 50% loss, So it's a huge, huge difference.
Yeah, that is huge.